All right. Hello, everyone. Thank you for joining us. Connor, Andrew, it's great to see you. So we're talking about customization when it comes to wealth management, and we're going to get to that. But we, of course, have to start with what's going on with private markets right now, and specifically what's going on with private credit and direct lending. So this is a question for both of you, and I'll start with you, Connor. What state of the credit cycle do you think that we're in right now?
I think it's important to put the current market in context because credit, private credit, and direct lending almost get used synonymously in today's environment. And we generally are of the view that credit markets are in good shape. Bank balance sheets are terrific, corporate balance sheets are strong, capital markets are liquid. Then you move to private credit, and we would suggest that most components of the private credit market are also in good shape. Real asset lending, asset-backed lending seems robust. Demand is outweighing supply. Credit spreads are strong. Covenant quality stays high. Then you get to direct lending. And there are undoubtedly some concerns about direct lending today. A lot of capital came in very quickly. Spreads tightened. Maybe some concerns about corporate credit quality. But it's important to recognize that is only a very small subsegment of broader credit markets.
It's a fair point. There's a lot of babies, a lot of bathwater right now being thrown around altogether. But Andrew, I would love to hear your perspective on that. When you think about where we are in the cycle, especially when you look into your portfolio, some of the fund flows that you're seeing, where do you think we stand in the credit cycle?
Yeah, I think Connor gave a good description of it. I think we have a lot of new investors into the market as well. A lot of individual investors, wealth investors, increasingly we'll see over time retirement plan investors. So I think some of these are just sort of natural points in cycle. Frankly, I think we need a little bit of a stress test scenario will help us kind of work through who the strong players are, but also that the way that it's getting delivered is time tested and can work. I think this is in some ways healthy.
Maybe to piggyback on Andrew's point, one of the things that we talk about is in today's environment, sometimes two concepts, one being corporate credit quality and two being the liquidity of the structures in which those credit investments are being held. They're kind of being conflated together. I'm sure in some cases both are appropriate,
right,
but not always. And I think when we talk about concerns around maybe software credit, that goes to credit quality. When we talk about liquidity in some of these credit vehicles, that doesn't necessarily mean the underlying credit quality in those vehicles is bad.
So there's a lot to dig into there. Let's start with the conversation around liquidity, because I come mostly from the world of ETFs, which is as liquid as you can get, but it is interesting to watch, the retail investor, the individual investor. I mean, retail is a broad church, but come into specifically BDCs and some of, the vehicles along those lines. I mean, you think about the liquidity mismatch, if you want to call it that, between maybe an investor who's more used to very liquid vehicles and what's actually being offered in some of these fund structures. Do you think that there is a structural mismatch or a misunderstanding there?
Yeah, I don't think so. I mean, I think a lot of that market's advised, and advisors, are thinking about asset allocation, risk management, education. It's also important to remember this is a market where private markets at large, where it's 0, 1, 2, 3% of an individual's portfolio, talking about taking them to 15% of an individual's portfolio. So liquidity is an important factor, but these are long-term investments in a natural sense. So again, I think there's some newness to it, but I don't think there's a mismatch at all.
And there's no doubt that these vehicles offer something incredibly beneficial to the market.
Yeah.
They allow investors that maybe perhaps historically have had the traditional bond or stock option, they can get exposure to something that diversifies their portfolio. They can get exposure to some key investment themes that maybe exist more in the private markets than the public markets. And these vehicles inherently work, and if they're structured appropriately and they're managed appropriately, and both the managers and the investors understand the parameters of these vehicles, they can be very beneficial. But we've seen in our business, you need to manage that liquidity appropriately, and when doing so, it works really well.
And you made an interesting point that Connor, when it comes to sort of the underlying quality of some of these portfolios that necessarily isn't the question here. It's more just liquidity expectations, but whether or not, the actual portfolios are in trouble. I'm curious from both of you, whether this experience that we're seeing, all the concerns that are out there in the private credit landscape right now, whether that might dent retail demand going forward when you just take a look at sort of the volume on some of these headlines.
I don't think so. It may be just to frame it. We think of the individual market being the wealth market, the retail market, the insurance policy and annuity holder market, and the 401k and the retiree market. And that market globally is actually twice as big as the institutional market, and it is only de minimisly invested in alternatives and private markets today versus institutional portfolios that you can take your number maybe mid-teens. So it has an incredibly long way to run. It will be incremental over years and decades to come. We don't see that trend being derailed by anything in the short term.
Yeah, I mean, in the long run, completely agree. In the short run, will there be hesitations? Of course, but I think this is a very long journey. And to the comment before, it's such a small market today, and it getting tested through points of stress. I mean, you cover ETFs widely. There was always discussion of fixed income ETFs were going to, be the end of the world, and they've been through many market cycles and crises. So I think it's a long term. We're going to be fine. In the short run, it could be a little bumpy.
Well, I wonder, how it's impacting how you're thinking through, Andrew, your partnership that Invesco has with Barings, because you think about October, you set sail on your first interval funds. Barings now co-managing that portfolio. I know that you had, or at least when the partnership was announced nearly a year ago, the plan was to roll out more products that were more geared towards that mass affluent investor. With some of the hiccups that we're seeing in the market right now, some of the concerns that we're seeing, are you being a little bit more thoughtful, or maybe delaying some of the plans to roll out those products?
Yeah, no delays at all. And we've been in the market, in the institutional market for decades. We've been in this part of the market with real estate assets and credit and equity in these interval fund structures for several years. The most recent thing we're doing is a diversified credit fund where we're co-managing it with Barings. And I think that diversified nature is pretty critical for that wealth audience that really does need to look across the entire spectrum of credit. And for those investors that don't have the opportunity or maybe the size to diversify on their own, this gives you an avenue to do that in a dynamic way. So in some ways, I think actually some of the dislocation right now should benefit that strategy. And we're looking to do more with Barings. We're looking to do more with our other partner, LGT, in this space, and then also in the retirement space.
And most of the conversation that we're having so far has focused, of course, on private credit. That is firmly in the market's crosshairs in terms of the focus right now. But, you think about private markets in general. Obviously, it is such an enormous bucket. So, Connor, I'm curious what you're seeing when it comes to private credit, how that stacks up sort of across different asset classes that fall under that private sphere.
What we're seeing in terms of private markets is continued growth. And if we could say it this way, the alternatives market has grown to where it has got over the last 20 years. And that's been largely an institutional market, and focus just institutions creating and then increasing their allocation to privates and alternatives. If you focused only on the institution, that market size is going to double over the next 10 years. Then you have this new additional growth lever, if you will, which is the individual market. And what I would say is the vast majority of private credit investing today is still done for institutions. And what we really focus on is ensuring that everything we've done in terms of investment discipline and approach for institutional investors, we take the exact same approach when we do something for the individual channel. And the tailwinds and the needs for capital within the private sector are only continuing to grow, and therefore there's going to be lots of demand and lots of support for both those verticals to grow over the next decade and beyond.
Interesting, yeah.
I was going to say, I think when Connor and I are both talking about institutional, it's natural to think defined benefit, but as you kind of pivot here to defined contribution, maybe even more important than the wealth space for individual investors is how defined contribution unfolds for private market assets.
And if I could even piggyback up on that, we sometimes turn this discussion into individual versus institutional. it's important to recognize that essentially all investing around the world is on behalf of individuals.
Yeah.
When we invest on behalf of a pension fund or a sovereign wealth fund, it's individuals behind that institution that are in fact the end stakeholder. And therefore, this is really just about an intermediary in terms of who you execute with, as opposed to actually changing who the end economic exposure belongs to.
It's a nice reminder that, people populate institutions.
That's right.
Institutions are serving ultimately people at the end of the day. But to the point, Connor, you made the point that, when it comes to sort of translating what you're doing for institutions into individuals, there's not too much change there. And Andrew, I wonder how you think about that. As you push more into, the mass affluent, the more individual market versus institutions, what does that translation look like for Invesco?
So it's pretty natural, actually, because being in the private market space for as many years, 30 years, in fact, and being focused on private real estate and alternative credit, and also being a massive partner to wealth managers in the top 10 here in the U.S. and in many major markets around the world, bringing that together and knowing what the needs are of those end investors and the advisors, how to structure product to certain unique needs, how to do client service, how to make the friction in the system more seamless. And I think a massive part of it is how to deliver education. And in the moment we're in right now, reemphasizes and underlines I think the importance of that education piece, not just at the product level or the asset class level, but at the utility level as well.
I couldn't agree more with two things you said there. In a lot of cases, in almost all cases, we're not changing what we invest or how we invest it. We're simply packaging it and structuring it differently for a different end investor and for a different distribution channel. But it's the same investing and the same type of exposure. And then Andrew's point on education is a very important one. Mm-hmm. We've spoken about, a little hiccup or disruption that maybe the markets are going through right now. I think this is just going to make everyone sharper around communication and education of how these products are structured, what liquid or semi-liquid or perpetual actually means, and what that means for both the investor and the manager.
It would be kind of fun if you guys did disagree, but it's probably nice that you guys
You never know.
We might find something.
That's where we have 15 minutes left. We'll find something.
We'll try.
Yeah. I do want to talk a little bit more about points of access because I can't help myself. I cover ETFs for a living here. Invesco, obviously, a powerhouse when it comes to ETFs. We've talked a little bit about, liquidity expectations. Do you ever see a world where, ETFs do hold private assets? There's a few fringe cases out there, but it's really a very nascent market.
Yeah, I think the coupling of private and public assets is going to take place in portfolios and packaged portfolios. We're seeing it today, and as that progresses, and I think as that the market gets more oriented and maybe as the vehicles get better, there will be more opportunities. I think right now there is so much to do in bringing private markets to individual investors. I think the ETF is an interesting vehicle, but I don't think it's the number one priority, certainly not for Invesco. And I think for the market right now, liquidity is critical. We know it's critical, but these are also long-term investment vehicles as well. And we really want to put them in vehicles and packages and product delivery mechanisms that can meet a lot of people's needs. And I think the ETF is a small use case right now.
Mm-hmm. And Connor, I'm just curious to hear your thoughts.
Well, the only thing that Andrew's
here's where we're going to disagree.
Response almost triggered me too is it's not all going one way, and I think that's important to highlight. I'll tell you, just within our business, we have listed public entities that really invest in Brookfield's underlying private funds, and it's a unique way for investors to get exposure to what's in the exact same assets and investments as those LPs that invest in those committed capital public vehicles, but it's for those investors who want that in a stock with daily liquidity and daily mark-to-market. So it is a two-way street, both putting privates into ETFs or other structures. Similarly, we're also trying to find a way to put it into public securities to access that market, and that's been very successful as well.
Yeah.
I mean, ETFs, we've been in the ETF business for over 20 years, and one thing that is absolutely true about the industry and about Invesco is innovation takes place. And so it's been 10 years plus that we brought our loan ETF, which was the first of its kind of the market. And, it's got some dynamics in it that create liquidity, and that's traded through many, many market cycles. I don't underestimate the ETF industry using innovation to create more ways. So, I'm excited about it. I just don't think it's priority one.
Yeah, it is really interesting. I mean, some of the conversations that we're having around private assets in ETFs, some of it has a very strong parallel to some of the conversations around fixed income ETFs, loan ETFs, to your point there. But we'll put ETFs aside for a moment because you both seized upon education. And this is a topic that came up during our prep call as well. Some people, when they hear education, their eyes glaze over. And, it can come across as something that you scroll quickly past. And I wonder, how you actually reach, the individual that we're talking about, the people that sort of populate your investors here in a way that is actually meaningful.
Well, I think we'll go back to this point that the alternatives or the private sector was built on the institutional market. And in that market, we would have a client team that would go speak to the individual LPs on a recurring basis, provide them updates, incredibly detailed explanations about the different products and solutions we'd offer. We are doing the exact same thing for the individual investor. We have a dedicated team, so it's not a shared resource. It's a dedicated team that's growing very rapidly around the world. And it goes beyond just having people that are out there educating and selling your products. If I can think about it this way, it's not simply about getting your product on the shelf. Mm-hmm. It's getting the product on the shelf and then also explaining the product and why it might work, but equally why it might not work for someone and perhaps they should focus elsewhere. So dedicated teams growing around the world focused on not just selling, but educating more broadly.
I mean, ditto. Having dedicated people, having deep resources. The one thing I'd add is to do it at scale and at mass, and I'm sure Connor's firm's doing the same thing, you have to look at different platforms and mechanisms. You can do it one-to-one as best you can, but you have to do it broader and at scale. I think the education is naturally always going to the product, but I think the education around the asset classes at large, how they operate, how to put them in portfolios, and how to help advisors who are very sophisticated in their own way take it forward and explain it in a language that's going to make sense to end individual investors too.
Mm-hmm. Sometimes we get a question, I'm not sure if you do as well, about consolidation in the financial services market. And one of the key drivers of that consolidation is the client service requirements. Yeah. Mm-hmm. and the regulation requirements in this industry continue to go up and up and up. And it really lends itself to larger institutions that can invest the time and the people and the resources to delivering and meeting that bar that is getting higher every day and only going to do so continuously into the future.
Yeah, I'm never surprised, actually. Every time when we go out and we spend time talking to wealth platforms and advisors, once you get past the product part and once you get past the asset class part, one of the biggest challenges for individual investors is there's a lot of friction. And so, like, time to get things completed, ability to put it alongside your other investments. And this isn't, this is GPLP funds, but also in interval strategies. So I think the more we can take that all those chains out and make it a much simpler process is really a benefit to individual investors, and it'll keep costs down too.
Mm-hmm. Well, Connor brought up consolidation, and I already mentioned the partnership that Invesco has with Barings, and I feel like partnerships are, sort of similar or a similar conversation to some of the consolidation conversations. But Andrew, I'm curious, why Invesco went the partnership route when it comes to, deepening the commitment to private markets versus, doing it in-house at Invesco.
Sure. Partnerships in the ethos of the firm. I mean, we have partnerships in joint ventures in India and in China, in Canada now. Across the way we built our $1 trillion ETF complex was a lot of partnerships. So it's kind of in the DNA, and it's culturally something we're very comfortable with. Secondarily, we really wanted to stick to our knitting in real assets and in alternative credit. And so looking for partners that could either give us extensions to things that we don't have, like private equity or secondaries or other parts of credit that we don't play in, upper market or special situations, was a better and a better outcome for clients, we thought, to be able to get to market thoughtfully and quickly with experts in things that we don't do, and then to utilize our distribution relationships and our client relationships. So it started with we're comfortable with partnerships. It went to finding ones that we're really culturally aligned with, that think long-term like we do, and then finding some spots where we just acknowledge that we may not be the best out there, and we can partner with others to get a complete solution.
What is your appetite for M&A? Clearly comfortable
Sure.
with partnerships, but would you ever take it all the way and outright buy someone?
Yeah, I mean, there's, we've talked publicly about it, where there's opportunities to add extensions to what I was describing. But for the meantime, and maybe forever, the partnership route and our, we have a $130 billion private markets asset base today, so we're not starting from nothing. So we'll continue to look at it, but we're pretty comfortable with the organic and partnership route at the moment.
And I'll ask you the same question. I mean, when it comes to how Brookfield Asset Management is sort of approaching the rest of the industry, are you, considering partnerships? Does M&A look more attractive to you?
We've done both, and we've certainly used M&A to build out our alternatives platform, in particular our credit platform in recent years through the acquisition of Oaktree and Castle Lake and other of what we call partner managers. I think the partnership approach makes a lot of sense in certain situations, because we should be very clear. There's going to continue to be growth across the spectrum. Public markets are going to grow, private markets are going to grow, and there's going to be incredible expertise and leaders in both of those. And partnerships allow you to take the best of both. Whether it's a partnership or an M&A, that's just a capital allocation decision. I think working together is a strategic decision that it seems like we're on the same page on. One's just a capital allocation decision.
And back to whether it's an institution or a wealth platform or individual investors, they want to work with less people. I mean, they want to work with fewer people that can first be high quality, but second can look beyond any individual situation.
I'm delighted to say we have an audience question, and you are able to ask questions. I'm delighted to say that this one also makes a lot of sense, so let me ask it. Do you think that individuals have a hard time truly understanding semi-liquid assets, perhaps better off making them fully liquid or keeping them liquid longer-term structures? A lot to chew on there. Who wants to take it first?
I think absolutely individuals are extremely capable of understanding a semi-liquid structure. I think managers of these structures need to be very thoughtful in how they build them over time. Not to go on too long here, but the reality is it's a perpetual structure. There's been institutional perpetual structures for a long time. It just happens to be in the wealth or retail market, most of the structures are perpetual or semi-liquid. And what we've seen is if these businesses are grown incrementally, such that sometimes you maybe need to restrain inflows such that you aren't taking a bunch of cash, you aren't having to invest unnaturally because of an inflow you weren't well equipped to manage. If you restrain the inflows to the deployment opportunity in the market and you manage the liquidity, I think you're fine. And I don't think it's on the investor. I think it's on the manager.
Mm-hmm. And Andrew, I mean, we've tread a lot of this ground, but...
I mean, the only thing I'd say is I think individuals are very sophisticated, and most of the investors in these funds are advised as well. And I think liquidity is always important, and typically you want it when there's a stress point. And so I think keeping people focused on their asset allocation and not fully on their emotions it's not exclusive to private credit or liquidity or private markets. It's a general investment principle.
Yeah, and it was about 20 minutes ago, I think, where you said, maybe a stress test is healthy here. It's going to be interesting to see how it all shakes out. But I do want to talk a little bit about deployment opportunities, particularly when it comes to AI infrastructure. I know that is a particular interest of Brookfield at this point. There's also a lot of money chasing the space, and I'm curious how you're sort of competing in that environment.
I would say AI infrastructure, investing in both the digital infrastructure and the energy production that supports AI, is one of, if not the largest investment theme at Brookfield today. And it's important to recognize that we are building the critical assets that provide the compute to either hyperscalers, the largest, best corporates around the world with the best corporate credit ratings, or to sovereigns. In both those cases, you have an exceptional counterparty on the other side, some of the highest corporate credit counterparties in the world. And we are only building when we get a long-term contract, and we are not taking a risk on the monetization or the performance of that compute, but rather simply on the corporate credit quality of that counterpart. And we are seeing, due to the demands in this space from those counterparties, we're seeing very attractive risk-adjusted returns. And the demand is I don't mean to sensationalize, but the demand is incredibly robust, and it only continues to accelerate. So we view this as one of the largest investment themes, both today and in the future as well.
And Andrew, I wonder, when you think about the demand in general that we're seeing from, the individual investor for private assets, how much of that relates to, the build out of AI that we're seeing? I mean,
sure. Connor, from an infrastructure perspective, which we're not in, clearly has all the great insights there. I think we've seen it across public investments, private investments. You've seen it in all forms of real assets, not just infrastructure. You've seen it obviously across the credit side. I think one thing I'll say in the public markets in particular, this narrowness that we had seen over the last several years starting to kind of break out in the last year to get more diverse, and we're certainly seeing it in the last couple of months and weeks here, I think is a healthy thing. But the AI build out and the demand is positive for the economy all around.
All right, we are exactly at 0 seconds. So thank you both, Connor and Andrew.
Thank you. Yeah, thanks.
Thank you, guys.